In today's video, we uncover a major economy teetering on the edge of total collapse. The state of this country's consumer is in dire straits, and when we analyze the bigger picture, it becomes evident why policymakers are growing increasingly frightened. Adding to the concern is the fact that the U.S. economy is showing signs of running out of money at the worst possible time. Simultaneously, the global economy is experiencing a notable contraction. These factors combine to create a sense of urgency in the minds of policymakers. The crucial point to understand is that when money starts to drain from the system, as we have been emphasizing, due to central bankers inverting yield curves and tightening lending standards, growth falters, and debt obligations become challenging to meet. Consequently, the wheels of the economy begin to show signs of strain and eventually fall apart. Interestingly, even during times like these, investors flock to U.S. equities as they perceive them as a safe haven. Bonds and foreign equities are often overlooked. However, when the downturn materializes, as we saw with Friday's incident, other companies will follow suit. One such company, profoundly impacted by the pandemic, embarked on a series of debt swaps and paydowns between 2020 and 2022. They resorted to buying back their own stock and accumulated substantial debts. In an attempt to reduce interest expenses, they closed approximately 200 underperforming stores and engaged in sale-leaseback deals. Remarkably, this company reported having over 100,000 creditors, and funds will be distributed to unsecured creditors. Astonishingly, the largest unsecured non-insider creditor, McKesson, claims $667 million in trade payables. This example illustrates the heavy debt burdens companies will bear during the upcoming economic downturn. The issue lies in the fact that as the demand for money surges during a time of decreased availability, bankruptcies become inevitable. Such bankruptcies will expose companies to financial distress, potentially causing stock prices to plummet. This scenario may catch many people off guard, as they are unaware of the extent to which these companies have accumulated debt. This outcome is the consequence of a decline in the overall amount of new money in a debt-based economy. According to the October 2023 Empire State Manufacturing Survey, business activity in New York State has been declining. The headline General Business Conditions Index fell 7 points to -4.6, indicating a potential lack of a soft landing and a revival in the factory sector. Further analysis of the report reveals that unfilled or new orders have slightly decreased, while shipments remain relatively unchanged. A significant factor to note is the decline in unfilled orders, indicating a decrease in backlogged orders. This suggests that companies are not prioritizing these orders and are instead focusing on reducing their backlog with available resources and labor. Despite this, there has been a slight increase in both employment and the average work week, suggesting that companies still have some confidence in the U.S. and global economy to bounce back. Looking at specific indices, the new orders index dropped 9 points to -4.2, indicating a small decline in orders. The shipments index also fell 11 points to 1.4, showing little change in shipments. The most significant change is seen in the unfilled orders index, which fell to -19.1, signifying a significant reduction in unfilled orders. Additionally, the inventory index remained below zero at -2.1, indicating a slight decline in inventories. The prices paid index remained steady at 25.5, indicating little change in the rate of input price increases. However, the prices received index fell 8 points to 11.7, suggesting a deceleration in the increase of prices for manufactured goods. This signifies that manufacturers are being squeezed at the margin since their costs are rising, while the prices they are able to sell their goods for are not increasing at the same pace. Eventually, they will deplete their backlogs, and if no new orders come in, they will have to downsize their workforce. The report also highlights the tightening of lending standards by domestic banks for commercial industrial loans. This implies that credit is being restricted, which often leads to a decrease in business activity. This pattern was observed in previous instances such as 2015 to 2016 and during the pandemic. Currently, there seems to be a lack of attention towards a major issue that has the potential to escalate into a complete collapse. It is crucial to address this problem, as there are no indications that it will naturally improve. The topic of central bankers and their ability to make credit readily available will be discussed later, but for now, it is important to note that many reports suggest that the availability of credit is becoming increasingly limited. The index for future business conditions has recently dropped by 3 points to 23.1. Surprisingly, despite this decline, firms remain relatively optimistic about future conditions. However, less than half of the survey respondents expect conditions to improve within the next 6 months. Additionally, the expectations for increased orders and shipments are also low. It is puzzling as to where this optimism is stemming from, unless there are people providing false reassurances about future orders. To gain a better perspective on the situation, it is necessary to analyze global trade. It is plausible that the global economy is experiencing a turnaround, but this improvement may not be reflected in the New York market. Freight Waves recently reported that U.S. container imports are still increasing and have even surpassed pre-COVID levels. While this does indicate some growth, it is equally important to consider the state of one's trading account. During a previous Sunday show, we shared an update on our reports that some viewers questioned. To answer their inquiries, we want to emphasize that our reports are indeed easy to use. For instance, the Nasdaq and QQQ show a 2% gain, with our signal indicating a purchase on the day depicted by the green candlestick. As of the time of this recording, the investment has yielded a 2% profit. Let's start by looking at the imports of the U.S. While a 2% increase in trade account may seem good, it is not significant in the import world. The U.S. imports have only risen by 2.5% in the first 9 months of 2023 compared to the same period in 2019. It is important to note that these levels are still below pre-COVID levels. The demand is far weaker than what is being suggested, as the increase is only 2.5%, which is not substantial for the U.S. economy. It should be much higher. The latest monthly outlook released by the U.S. highlights that cargo volumes will still be strong for the remainder of the year, but not as high as initially expected. Retailers have stocked up early this year to counter any potential supply chain labor issues and are well prepared to meet customer demand. However, it is unlikely that customer demand will be high, as consumers have run out of pandemic stimulus and face increasing credit card payments due to rising rates. Additionally, student loan repayments have resumed. This does not bode well for the U.S. consumer's ability to spend during the holiday season. The revival in the global manufacturing sector, which was expected during the holidays and back-to-school season, has already occurred. Retailers stocked up early in preparation for this revival. However, if the U.S. consumer fails to come out and spend this holiday season, it will have a significant impact on the economy in the beginning of next year. Spot rates, which can serve as indicators of economic health, have been declining, signaling a weakening in volumes. Now, let's turn our attention to China. China is a major economy that is currently experiencing a downward spiral. Once an economy starts spiraling downward, it becomes challenging to reverse the trend. Monetary and fiscal measures, such as cutting interest rates and providing stimulus, often do not have the desired effect. Once the downward spiral begins, it becomes too late for central banks to react effectively. Unfortunately, it seems that it is already too late for China, and this is bad news for the global economy.